Have you ever felt like you're playing a different game than the big institutional traders? While we're staring at a dozen different indicators, trying to make sense of the noise, they're looking at the market through a completely different lens. It's a lens that's grounded in statistics, not just signals. So let's dive into what that professional approach really looks like. I was talking to a friend who works as a quant for a major trading firm, and he basically said they don't hunt for magic indicators. It's just not what they do. Instead, they focus on proven mathematical and statistical principles. And the core of their whole approach? They transform all the raw price data into something called a Z-score. That's their secret for measuring probabilities and building their models. And this slide, this just captures the difference perfectly. On the left, you've got what most of us are used to seeing, right? A total mess of oscillators that are probably contradicting each other. It's chaos. But on the right, that's the quant approach. They take all that noise and turn it into one clean statistical distribution. And in this explainer, we're going to break down exactly how you can start to see the market in that same clear way. So what is this magic bullet? Well, it all boils down to a pretty simple concept from statistics called the Z-score. Now, don't let the name scare you off. A Z-score is actually a really simple idea. All it does is measure how far away the current price is from its recent average. The key is that it measures that distance in a standardized way. So what's the big takeaway? It takes messy, chaotic price action and organizes it into a predictable, standardized pattern. And this bell curve is what makes it all click. It shows us exactly what the Z-score is doing. Everything gets centered around an average of 0. This lets us see at a glance when price is just doing its normal thing, hanging out in the middle of the curve. But more importantly, it shows us when price is stretching into a statistically significant extreme, way out there in the tails. And that's where the opportunities are. Okay, so the best part? You can actually get a tool that does all this for free. If you're on TradingView, just pop open the Indicators menu and search for Adaptive Z-Score Oscillator. Make sure you pick the one by Quant Algo. We're going to use it for the rest of this analysis. Oh, and just one quick tweak, go into the settings and change the length from 20 to 34. It just helps smooth things out a bit. All right, tools loaded up, let's get down to business and see how we can actually use this thing to get an instant read on the market. The most basic, but maybe the most powerful feature is trend identification. And it honestly could not be simpler. If the histogram is green and above that 0 line, we're in an uptrend. If it's red and below the 0 line, we're in a downtrend. Boom. Just like that, you have your market context. No more guessing. But wait, what about these little gray bars that pop up? This is where it gets really smart. The gray color is a signal that momentum is weakening. It's taking a little breather. So during a strong uptrend, when that histogram flips from green to gray, it's flagging a potential pullback. And once it flips back to green, that could be your signal that the pullback is over and the main trend is kicking back in. It's a fantastic way to spot those lower risk entries. Okay, so we've got trends and pullbacks covered. Now let's get into the really exciting part, using this to spot major market turning points. So this slide gets to the heart of a huge problem with standard oscillators like the RSI. You know how they have those fixed overbought and oversold levels? Well, in a strong trend, they just give you false signal after false signal. It's so frustrating. But the Z-score oscillator is different. Its thresholds are dynamic. They actually expand and contract with the market's volatility. And what that means for you is a drastic reduction in those false alarms. So how do we actually use these dynamic lines? Well, when the histogram bars cross above that moving red line, the market is considered statistically overbought. When they dive below the green line, it's oversold. Now, in both cases, a turn in price is expected. But, and listen, this is a crucial point, a turn doesn't always mean a massive reversal. Sometimes it's just a minor pullback before the trend roars back to life. So that begs the question, how do we spot the major reversals, the ones that really matter? We combine those extreme readings with a super powerful concept called divergence. This is what happens when the price is doing one thing, but our indicator is doing the complete opposite. It's like the market's engine is sputtering, a massive clue that the underlying momentum is shifting, often right before a big change in trend. Let's walk through a classic example of bearish divergence. You see right here, the price pushes up and makes a new high. But look down at the Z-score oscillator. It makes a lower high. The price and the momentum are telling two different stories. They disagree. To confirm this, we can just mark the little low point between those two highs. A candle closing below that level, that's our signal that the top is probably. And of course, it works the exact same way for bottoms. Here, the price makes a new lower low, but the indicator just refuses to follow. It puts in a higher low. This is bullish divergence.
And it's basically telling us that the sellers are getting exhausted. Again, for confirmation, we can mark the high point of the price structure between those lows. A close above that level tells us a bottom could be in place and a new uptrend might be starting.
Look, having a powerful tool like this is a game changer, but it's only half the battle. To really get that professional edge, you have to pair it with a professional framework for thinking. First, context is everything. This tool is for analysis and validation. It's not a crystal ball. Never use it in isolation. Second, you have to embrace uncertainty. No system is perfect, and losing trades are just part of the business. It's okay. And finally, risk is absolutely non-negotiable. A pro always has a risk management strategy, like risking no more than 1% of their capital on any single idea.
And this chart, wow. It just brings everything we've talked about together so beautifully. You can see the entire market story play out. The red histogram clearly shows the downtrend. Then the bullish divergence gives you that early warning that a bottom is forming. The green histogram confirms the new uptrend. The gray bars pinpoint those low-risk entries on pullbacks. And finally, that bearish divergence at the top warns you that the party might be over. It's a complete statistically grounded narrative of the market.
So I'll leave you with this final thought. By shifting your focus away from chasing the next hot indicator and instead focusing on understanding the statistical nature of price itself, how might that one little change in perspective fundamentally transform the way you see and interact with the market?